Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. We're coming to you from the George Washington University. This is the GW Investment Institute podcast for students. That's what we're here for the Investment Institute. This podcast is for the broad listener group and the people that watch us on the YouTube channel. Thank you so much. Continue to send us good vibes. Subscribe, send comments. We love all that. Remember, entertainment and educational purposes only, not investment advice. Disclaimer up front and at the tail end here. We're coming to you from the George Washington University School of Business, Duquesne Hall, Duquesne Family Studio. Shout out to the Duquesne family. As always, thanks very much. Great studio that we have here. We really appreciate everything. All right here from the heart of Foggy Bottom. This episode is going to be a general market news, which is what we do at the beginning of our classes, which is, hey, we're going to do a general overview on what's happening in the market. Students bring in things. We had a great wrap to the spring semester, so thanks again to all of our students and faculty, staff, the team members, our advisory board members, alumni, everybody that made all the things happen. We had a great semester. Obviously, maybe it's not obvious, but for those who don't know, we generally don't run programming in the summer or classes in the summer. And so that time will be off, and we'll be back to work in the fall semester. We'll obviously continue to monitor the portfolios at the Investment Institute with our great team, and so we really are looking forward to welcoming students back after the summer break, and they're doing internships or all the great work that they might be doing. We'll welcome them back in August. All right, so to get to work here, we're going to cover, again, some general news and what's happening overall in the market. So one of the things that you heard on the Caher report is the Strait of Hormuz is opening. That's happening, and it looks like that's going to have a very sizable impact on the opening of the Straits of Hormuz and rather the oil market. So that's going to be a big bonus, and that's having an immediate price action with oil prices going down into the 70s from over 100. So you're absolutely seeing some really positive things happening there on the economic front. All right, but let's talk and focus most of this on the equity markets. The Caher report covered a broad scope of things from the economic viewpoint. Where our chief economist, Kathleen Hinman. Thank you to Kathleen for that episode as well. We look to the next installment of the Caher report. So let's check in on the equity markets, though. So when we talk about what's happening in the overall market, there's quite a few things. We'll mention a couple things that are happening at some individual company level. But let's first start with what's happening at the index levels. And so when you talk about the overall market, lots of people, including us, use the S&P 500 as the index to say, well, okay, this is the 500 largest companies. It's fairly representative of what's happening in the overall market. Well, there's been some ups and downs, as you know, for the year-to-date number. But the year-to-date number, and this is through mid-June here, we're talking 10%. So that is a fantastic mid-year return if you're following along and paying attention at home and keeping score. 10% could be, let's say, your long-term average return, maybe even a little bit lower than that. And if you use the rule of 72, and if you're not familiar with that, if you take the return and you say 72 divided by the return, it will take that many years to double. And so that will be 7.2 years. And if you did the reverse and you said I'm compounding at 7.2%, it would take you then 10 years to double. And so that's the rule of 72. And it's a helpful way to understand, okay, well, how you double. And so if you're at 10% right now for the half year, now you could stay flat, give some back, and end up at the 10. The long-term average around 10 for the S&P 500. So you're doubling, again, every 7.2 years using the rule of 72 for that. But it's important, this is an excellent year-to-date return, but you've had up and down in the market, obviously. And off of the news that things are settling down and everybody's optimistic that this deal will hold in the Middle East with the U.S. and Iran, that oil prices are down, stock market generally has been up, and the stock market has been kind of pricing this news in a little bit already, but it remains positive news overall. And so some of the things to think about, obviously from the equity side is, people consider valuations could be a little bit high here, and there's lots of attention on some of the names, specific names, which we can talk about. But let's move over to the NASDAQ. To check that, we hold a lot of tech companies, and remember, not investment advice, in the portfolios across the GW Investment Institute. And so I think it's worth checking in on what's happening with the largest 100 tech companies. So the NASDAQ composite here, the year-to-date, even better. So you're at 14%. So a fantastic year-to-date return so far, again, through mid-June here. So, but it is important to think about, there is up and down here, and the AI race is on, and we keep talking about that. Some of the companies that we consistently talk about, Nvidia is in there, Apple is in there, and interesting, Apple, which we'll call it here in a second because that's one of our largest holdings, is not doing well in the AI game. And I would have to say there's a transition, which we talked about happening at the CEO level, that they still remain behind. They had their developer conference, and they announced that Siri's going to get upgraded. Not sure when. Still waiting. Thank you, Apple. Let's hope that they can make that happen faster. Siri remains not great. No offense, Siri. Certainly versus some of the other models, I think it lags behind, and now they're going to be using Gemini for that. So when you pay special close attention to Apple, obviously the ecosystem that they have built, is very sticky. And we talk about them having pricing power. But on the AI front, I think that's challenging. All right, back to the major index first, and then we're going to go into a couple of companies to talk about individually here. Not a full deep dive on any of these companies as we do on some of the episodes, but just to check in. And some of these are our larger holdings for the Investment Institute that students have either put in the portfolio or remain in the portfolio. So again, great job to all of them. The year-to-date number, as I mentioned, 14%. And okay, well, what's the year-over-year number? Even better to 34%. Again, there's been ups and downs here, but the market continues to charge ahead on the NASDAQ. And again, led by the tech sector, led by AI here, really, for the last certainly few years, that has been the case. Obviously, you can pick moments where they've lagged behind, or the AI trade hasn't worked, or the Mag 7 hasn't worked more recently. But if you look over the past, let's say, 3 to 5 years, you've really had strong performance from a lot of these companies. And the AI trend continues here. And if you look the year-over-year number back to the S&P 500, just to give the comp there, you're talking 25%. And so again, 25% for the year over year and 34% for the NASDAQ, respectively there. Again, 25 for the S&P 500 and 34 for the NASDAQ. All right, so let's jump into a few specific companies. I mentioned Apple here. Again, they say they're going to, upgrade Siri. We're all, again, waiting very impatiently at this point. The year-to-date number is, not bad, kind of market perform here, 9.78% through mid-June here. So kind of right on top of the S&P 500. And as I mentioned, everybody wants Apple to perform. Well, not everybody. Many people, we're Apple shareholders. I shouldn't say everybody. Apple shareholders and people who are consumers of Apple want Apple to perform better with respect to AI and what's happening there. And we're all waiting, right, impatiently at this point with what's going to happen with the upgrades and how is this going to drive growth through the company. And, share buybacks have been super positive, but what we really want from Apple is growth. And so that's something that I think we really need to pay attention to. All right, moving on here. We're going to check in on a bunch of different companies that are larger holdings for the Investment Institute that our students have put in the portfolio. Again, not investment advice for any of these companies individually or in the aggregate, educational entertainment purposes only. So let's check in on Amazon. So Amazon obviously has been a big part of the AI trade here, and that is AWS, Amazon Web Services, and their Trainium chips that they have put in place that people are using, like Anthropic, to build and run, or to run their models rather, for Claude. And so what's the year-to-date number? Actually, a kind of a market underperform here. So if you're looking at the overall market, we're around 10, and we're at 7, just over 7%, 7.25% here for Amazon over the same time period. So not fantastic, but there was some dips and a pull up here. But if you look at the year-over-year number, a little bit better, closer to market there, 15%, but still trailing the overall, the market. For the S&P. So kind of an underperform. It was 25, as we mentioned, for the year over year. But I do think it's important. It's been performing a little bit better more recently. So if you look at the 6 months there, a little bit better, 11%. And as a reminder, we're not short-term investors. We've held Apple from the Investment Institute as one of our original trades all the way back in 2005. And so we're certainly not short-term. And, it's not something that we talk about and really teach to trade there are people that are good at that. But what we really teach is how to be long-term investors and people that we want our students to focus on. How do you think about a company in the long term? Now, the long term, it's really hard to think out 10 years, and you can be a holder for 10 years. But as an analyst, investor, business person, what we're trying to train for is how do we use our framework, business management, price valuation, and balance sheet to think about what's the next 1, 3, and 5 years. And so in the business model, how can they be effective? The team that's managing it, what are the price that we're paying or where we're holding this, or maybe we need to trim it. And certainly what's the risk in the balance sheet and the capital structure. And so we're focused in on that. So I'm giving you some of the stats here, but just informational purposes only, just to keep track. But we own these companies and we try to own them for the long term. All right. Another company that I think that is worth watching is Berkshire Hathaway. That's another holding. It's been a long-term holding for the Investment Institute, very famous. Warren Buffett has stepped down as CEO. Greg Abel is at the helm, and they had the first annual meeting without Buffett being the CEO. He asked the first question. This was in May. And so I think it's important for us to keep track of this. As I mentioned on some other episodes, if you're following along here, Berkshire is sort of the contra AI trade. And so if you're a little bit worried about what's happening with the AI trade, well, Berkshire is piling up cash beyond $300 billion and really is not super exposed to the AI world. One of its largest holding is Apple. So you would say, okay, well, even with Apple, they're not super exposed to the AI trade because, you could make the argument that Apple's kind of the large tech contra AI trade right now, that they haven't overspent on that. And Berkshire owns a big chunk of Apple, and the rest of their portfolio, railroads, insurance, exposed on the insurance side, I think quite by a lot, which we've talked about. But I would say the contra AI trade, and if you had a sell off, they could be in a position to deploy capital. And Greg Abel has already done a purchase here of Home Builder. And so, not a huge number, but I think it is important to watch what Berkshire is doing. And if you look at the year-to-date number, market underperform on that. And so minus 1% through mid-year here, and the 1 year, year-over-year here for June is 1.5%. So not doing fabulous, but if you're worried and you want to put a hedge in the portfolio, not investment advice, but I do think it's the contra AI trade and something that as an analyst, business person, investor that you should be considering, thinking about, keeping track of, and I think that's super important. All right, going to touch on a couple other companies, and we've talked about all these companies generally speaking before in some way, form, or fashion, whether it's individual episode or covering them, but again, kind of a market check. But we're checking on some individual companies. All right, Google, we also own shares here. Alphabet is the parent company, along, in the Mag 7 here. And so if you look at the year to date, actually, they've been doing quite well, up 18%, closing in on 19. And if you look at the year over year here, you're talking up 110%. So they have actually performed very well over this period. A lot of people consider them the most integrated AI play out there, which I do think it's important to watch them. Now, on hot take on frontier models, where do I think the frontier models are right now? And this is highly biased. It's not based on all these benchmarks that people use. It's based on my benchmark of the things that I use and how I use them, which is mostly around producing things that are investment analysis. Now, occasionally, I do use Gemini for art, especially when I'm doing DJ Lake Superior gigs. That's my DJ handle there. And so we'll be doing one in New York for alumni, summer in the city, August 4th. Make sure you're there if you're an alumni in the New York City area. All right. But for investment analysis, the two models that I think have performed the best, and I would say one still wins out, I think, at least for me, is Claude and then ChatGPT with OpenAI. So Claude with Anthropic and then ChatGPT. And so I think Gemini and Grok are in a step down at this point. And I do think that they're good models. I think that they can be very useful. And I think in use cases, I think they're very good. Particularly on some of the things for Grok, if you think that there's data in X platform that is quite timely that you want access to, trying to run some type of analysis, then and maybe that's important. And then with Alphabet, if you have Google Workspace and a suite of products from from Alphabet, I think that that's quite useful. So I think there are different use cases. And if you think about what's happening here with respect to how you use these models, how you interact with them, it may not be a winner-take-all market. It may be there's some specialization that's going to continue to happen, and that people are going to use different models for different things. And that's just going to how it's the market will evolve. And obviously, you're going to work to integrate things as you go. But it seems to be who's on the frontier for me. I would put Anthropic at number one. And you see the government shut down Mythos. And so I think that, I think that's interesting to be noting that the government has stepped in. And I do think that Claude is out in number one. Some anecdotal information, when we were building our models for our quant class, I think most people converged on using Claude to build their models. And I do think, for me personally, and for the things that we did for the Investment Institute this past semester, I think Claude really is the number one. So that's the hot take for the frontier models for investment analysis, the way that we're doing it at the GW Investment Institute. I think Claude is up front, and I would put Codex behind that. Some people would switch those two, the OpenAI's Codex versus Claude Code. Now, some things to note. The market's moving pretty quickly. SpaceX, which I'll mention, just had a deal, an option to buy Cursor, and the second day public, the third day public rather, the deal has been announced that they're acquiring it, $60 billion. So I do think that that's interesting to watch. And so Cursor has been a really fast-growing software company to help with the coding, and so integrating that into Grok Build now will be interesting to watch. And so, all right, back to Alphabet again, vertically integrated. I think it's interesting. Market cap there, $4.5 trillion. So massive company, has done super well. One of our holdings and has been for a while, and so obviously we'll continue to watch what is happening there. All right, so a couple other names that I want to check in very quickly. Just want to check in on Microsoft here. Don't want to spend a ton of time, but certainly one of the massive companies, the Azure platform for cloud services, $2.9 trillion market cap. The year-to-date number here, this is a massive underperform. Why I want to mention it, it's down almost 19% on the year-to-date number. People are concerned that it's falling behind, and 18% on the year-over-year. Worth watching. We haven't done anything with dramatically with this, but I do think it's worth watching and seeing what's happening there. Certainly has a different outlook, at least at the moment, for where it was versus, let's say, a couple of years ago when a lot of people, or maybe 2.5 years ago, when a lot of people thought it was in the driver's seat with its stake in OpenAI and the early link up. And now it seems like that's possibly a disadvantage for them, and that has set them back possibly from building their own types of models. So I think important to watch, and something that we'll have to pay attention to. And I think investor, business person, analyst, you'll need to pay attention to that. Now, it wouldn't be an episode without talking about Nvidia, especially talking about tech companies. Large holding for the Investment Institute, remains the largest holding across our funds here, and so important. And our students have affirmed that this past semester. So again, not investment advice, but I think Nvidia remains a cornerstone in the AI world, and they continue to be in high demand. A couple of things that I'll mention about them after I give some data here. So the year-to-date here, 12%. So, modest, let's say, outperform from the market. And again, I'm not super focused on the short term, but just to check in on the performance. But the year-over-year is still very healthy, 44%, outperforming the S&P. Check in on the data here. Market cap, $5 trillion, so massive company. The 4P is still relatively, I think, okay. You're in less than 30, depending on what you're using for earnings expectations here, but certainly not, I think, for the type of growth that you're getting, expensive on this company. And some people are arguing out there, analysts, that, okay, this is actually undervalued at the moment. One of the things that I think is important to note. So as an analyst, business person, investor, how can we try to understand what's happening with respect to the competition for this? Obviously, CUDA is a very sticky platform and has been, and I think it's important to watch. Some other things that are, I think, interesting is that you had actually SpaceX, we got the S1 filing, have deals with both Anthropic, over $1 billion per month to use Colossus, which is principally Nvidia GPUs. And then they had another deal with Google, who has TPUs of their own, and a lot of people talked about as competition, over $900 million a month for renting of AI data centers from SpaceX. And so I think it's kind of interesting to pay attention to this. And they're using Nvidia GPUs, so that they felt compelled to spend nearly $1 billion a month in the case of Alphabet, and over $1 billion a month for Anthropic for access to this for training their models. And so while some people say, okay, this competition for the TPUs and the Trainium chips is, eating away at the pie for Nvidia, which again, I think you have to take that seriously and do the work. But in my humble view, and again, not investment advice, is the pie is growing, and it is growing substantially. And now how this all ends up in ROI, I think we all have to pay close attention to what is happening there. But I think it's important to pay attention to what's happening with respect to how Nvidia remains, I think, at the center of this ecosystem. Obviously, it's been buying companies and making investments in AI companies, and it remains, to me, at the center of this ecosystem, and something that we have to continue to pay attention to. I think there's a lot more analysis that needs to be done here, but it looks like some anecdotal evidence here. The position remains strong. Jensen Huang, huge fan of, won't hide that bias there. 40 Direct reports, doing a great job. Co-founder of the company, lots of great things to say about his capital allocation skill and his willingness to work super hard to make things happen and push things forward. So all good for Nvidia there. Last thing I'll just mention, and this is obviously worth something on its own, but to close out here, talk about SpaceX. So SpaceX went public on Friday. Market cap's now $2.7 trillion. They just acquired Cursor, as I mentioned, to go with XAI. And so SpaceX, obviously, a storied company already, 20 plus years in the making as a private company, now gone public. So Elon Musk and company continue to fire on all cylinders here. So we'll see what happens there, but worth paying attention to, I think, moving forward. And we've talked about data centers in space. And so being an analyst with respect to SpaceX, I think, is going to be important for all of us in business, because I do think, again, humble view, not investment advice, that the space industry will be consequential, important as business people, investor, and analysts moving forward. So getting up to speed now, I think, is a great service for yourself to make sure that you're understanding what's happening with respect to the overall market. All right, that is it for this episode. Thanks for being here. Thanks for watching on YouTube and listening on Apple or Spotify. If you have comments, we'd love to hear them. Please subscribe. And stay tuned for the next episode. Thank you very much. That's it for this episode of Market News with Rodney Lake. Disclaimer: the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.